Imagine it's 26th March 2013. You are a 56-year-old print shop owner living in Nicosia, Cyprus. Your shop sits on a side street where wedding cards, school flyers, and restaurant menus pay the bills. You keep your savings in the bank because that is what careful people do, and because you need those euros for paper deliveries, rent, and your daughter's tuition. Every morning starts the same way. Coffee, keys, shutters up, then a quick look at the account balance before customers arrive. The numbers on the screen look solid, neat, permanent, like stones set into the ground. If you have ever wondered what really happens to your money when banks start failing, stay with me. What you are about to hear is not a theory, it is a pattern. It has happened before, in rich countries and poor countries, in democracies and dictatorships. And if this kind of historical clarity matters to you, subscribing takes 2 seconds and keeps you ahead of what most people never see coming. Then the doors stay shut, the banks do not open, the cash machines spit out limits instead of freedom. On television, the president calls the rescue painful but necessary. Reuters reports that the country's banks hold 68 billion euros in deposits, including 38 billion euros above the 100,000 euro insurance ceiling, a staggering sum for an island of about 860,000 people. You hear that Laiki, the country's second largest bank, will be wound down, that large deposits will be frozen, and that ordinary life will continue under capital controls, which means the government now decides how fast money may leave the system. In the space of a few days, money changes shape. It is no longer just yours. It becomes a claim, a promise, a place in line. That is what this video is about. Not the stock market, not abstract finance. The simple, frightening question of what happens to your money the moment banks start failing. History shows that the answer depends on 3 things. Most people never think about when times are calm. What the bank actually did with your money, what the government can still afford to guarantee, and whether confidence breaks slowly or all at once. When those 3 forces collide, collapse is rarely a single explosion. It is more like a harbor at low tide. The boats do not sink because of one wave. They sink because the water they trusted is suddenly gone. Before we go further, there is something important to understand. Most people imagine a bank as a vault. You put money in, the bank stores it, and when you want it back, it is waiting there like a coat in a closet. That is not how banking works. A bank is closer to a bridge made of timing. Your money can be withdrawn today, but much of it has been lent out for years in mortgages, business loans, government bonds, and other assets that cannot be turned into cash in an instant without taking losses. In other words, the bank promises daily access to money it has tied up in long-term bets. That mismatch is the heart of the story. Economists call it maturity transformation, which simply means borrowing short and lending long. The bank takes in deposits that can leave at any moment and turns them into loans that come back slowly. Most of the time this works. In quiet years, only a small number of customers want cash on the same day, and new deposits usually replace the old ones. But when fear spreads, the system behaves like a theater with one exit and a fire alarm. It does not matter if there are enough seats for everyone. What matters is whether too many people move at once. This is why confidence is not a side issue in banking. Confidence is the oxygen. The St. Louis Fed explains that before the Federal Reserve was created, banking panics often became domino events. One bank failed, customers at other banks panicked, and even healthy institutions were dragged into runs because people no longer trusted the system. A bank can die because it is insolvent, which means its losses are too large to survive, or because it is illiquid, which means it cannot get cash fast enough. To ordinary people, those 2 things feel the same. The card stops working. The branch says, wait. The balance is still on the screen, but access has become the real currency. And this is where history gets uncomfortable. The moment banks start failing, your money enters a kind of legal sorting machine. Some of it may be insured, some may be frozen, some may be repaid later in weaker currency, some may be converted into bank shares you never wanted, some may survive untouched if a stronger institution buys the bank overnight. The number in your account is only the first layer. What matters in a crisis is the rank of your claim, the speed of the rescue, and the size of the hole no one saw until the floor gave way. This brings us directly to Argentina. In late 2001, Argentines were living inside a system that looked solid right up until it did not. For years, 1 peso had been pegged 1-for-1 with the US dollar. That fixed rate gave people a feeling of safety. Salaries were planned in pesos, savings were stored in dollars, and the entire economy sat on the comforting idea that the bridge between the two would never break. But under the surface, the rot was already in the beams. The government was heavily indebted. The economy was shrinking. Banks were stuffed with government debt, and many loans and deposits were tied to dollars, even though ordinary incomes were not. At the end of November 2001, the run became visible. According to the IMF, private sector deposits fell by more than $3.6 billion, about 6% of the deposit base, in just 3 days. That is the moment when a rumor becomes a stampede. On 1st December 2001, Economy Minister Domingo Cavallo imposed the corralito. The name sounded almost gentle. It meant little corral. In practice, it meant depositors were fenced in. People could move money electronically, but cash withdrawals from individual accounts were limited to 250 pesos a week. Imagine working all month, saving for years, and being told your own money now arrived in spoonfuls. Ordinary life changed immediately. Families who trusted banks found themselves hunting for cash. Small businesses struggled to pay suppliers and staff. People who had played by the rules discovered that the rules had been replaced overnight. Soon the crisis spread far beyond the banks. There were protests, roadblocks, and the famous cacerolazos, the street demonstrations where people banged pots and pans because they no longer trusted speeches. In December 2001, President Fernando de la Rua resigned and fled the presidential palace by helicopter, one of those images that tells you a financial crisis is never just about finance. It is about the moment a private fear becomes public collapse. But the worst part had not even happened yet. In early January 2002, after the convertibility system ended under the new president Eduardo Duhalde, the withdrawal rules were changed again. The IMF describes a shift from the corralito to the corralon, a deeper freeze that trapped time deposits and kept many dollar deposits locked up. The monthly cash limit was raised to 1,500 pesos, but that mattered less than it seemed because the value of the peso itself was coming apart. Then came what the IMF called asymmetric pesoization. Dollar loans to the private sector were converted at 1 peso to the dollar, while dollar deposits were converted at 1.4 pesos to the dollar. That may sound technical. In plain English, it meant the state rewrote contracts in a way that shoved losses onto bank balance sheets and depositors at the same time. Look at the cruelty of the mechanism. First, people feared the banks and tried to withdraw. Then the government froze access to stop the run. Then the currency peg broke. Then savings held in dollars were converted under new rules while prices and exchange rates moved in another direction. It was like trying to escape a flood by climbing to the second floor, only to discover the staircase itself was being rebuilt under your feet. The money did not always vanish in one clean confiscation. It was weakened, delayed, redefined, and repaid under terms people never agreed to. What did ordinary Argentines actually experience? They experienced time as a weapon. Bills still arrived on schedule. Access to savings did not. They experienced the difference between owning money and reaching money. They experienced a fact that returns in crisis after crisis. When the banking system is tied too closely to a desperate government, your deposit is no longer only a claim on a bank. It is also an indirect claim on the state behind it, and if the state is running out of road, the bank often runs out of road with it. Here's something I want you to think about before we go further. If the number in your bank account can stay visible while the cash becomes unreachable, do you still truly have the money in the way you thought you did? Drop your answer in the comments. Seriously. Because what I am about to show you next is the part of this story that most people never hear. And once you see it, it becomes very hard to trust appearances. This leads to the second part of this story. Greece in 2015 did not look like Argentina in 2001. It used the euro. It was inside the European Union. Its banks operated under a modern financial architecture that many people assumed would prevent exactly this kind of panic. But history has a habit of changing costumes while keeping the same script. By June 2015, after years of debt crisis, recession, and brutal negotiations with international lenders, Greek banks were bleeding deposits. Confidence was leaving faster than political leaders could restore it. On 27th of June 2015, bailout talks broke down. The European Central Bank froze the emergency funding lifeline that Greek banks depended on. The next day, Athens closed the banks, shut the stock market, and imposed capital controls. Reuters reported a daily withdrawal limit of 60 euros from cash machines. 60 euros. That was the official pace of daily life in a country of more than 10 million people. It was not a full confiscation. It was a rationing of normality. And look at how fast the social fabric began to tighten. Reuters described long queues in supermarkets as people stocked up on essentials. There were lines at petrol stations. Tourists searched central Athens for working ATMs. Greek households had already been pulling billions of euros from their accounts in the weeks before the shutdown. People were not irrational. They were responding to a system that was visibly cracking. In a banking panic, rumor behaves like smoke in a hallway. Even if you do not see the fire, you move because others are already moving. The human cost was uneven, and therefore even more painful. If you were paid electronically but needed cash for rent, medicine, or groceries, your world shrank to the withdrawal limit. If you were an older pensioner without an ATM card, the problem was worse. News images from that period showed elderly Greeks waiting outside banks for access to small amounts of money, not because they had gambled in the market, but because their lives had been built in a system that suddenly demanded digital habits from people who had spent decades using paper and cash. A financial crisis often punishes the old with procedures designed by the young. What mattered beneath the surface? Again, timing. Greek banks did not keep stacks of idle banknotes equal to all deposits. They relied on confidence and on central bank support. Once depositors pulled out cash and the ECB capped emergency assistance, the system no longer had room to absorb fear. The bank holiday and capital controls were not signs of recovery. They were shock absorbers bolted onto a vehicle already skidding. They slowed the crash. They did not erase the reason for the crash. There is another lesson here that people often miss. Your money can be legally protected and still functionally trapped. Greek leaders repeatedly promised deposits were safe. In one sense, that mattered. In another sense, many people needed access more than reassurance. Safety on paper does not buy groceries if the line at the ATM is longer than your patience and the machine goes dark before your turn. In banking history, liquidity is not the same as solvency, and neither is the same as peace of mind. Look at what happened next. Greece did not become a Mad Max wasteland. Life continued. Cafes still opened, ferries still sailed, salaries were still discussed. That is precisely why these episodes are so deceptive. Bank failure does not always arrive as total chaos. Sometimes it arrives as friction. A card declined here, a limit there, a transfer delayed, a payment approved for one purpose but not another. The cage does not need bars if the doors are controlled by rules you did not write. Now here's where it gets interesting. Lebanon after 2019 showed a different variation of the same disease. There, many depositors were not told in one dramatic speech that their savings were gone. Instead, they lived through something slower and in some ways more corrosive. The account remained, but the value leaked out of it day after day, like water from a cracked cistern. Lebanon had long financed itself with inflows of dollars, remittances from people abroad, banking confidence, and a fixed exchange rate of about £1,500 to the dollar. For years, that arrangement gave the country a polished look from a distance. But Reuters described the system as one some economists compared to a nationally regulated Ponzi scheme, meaning new money was constantly needed to keep old promises alive. The warning signs were there. The country had a debt burden equivalent to about 150% of national output before the full collapse. In 2016, banks began offering remarkably high rates on fresh dollar deposits and even higher rates on Lebanese pound deposits. That is usually not a sign of strength. It is more like a lighthouse flashing in daylight. If a bank or a country needs to pay unusually high returns for ordinary money, it is often because ordinary money is becoming hard to attract. Then came October 2019. Protests erupted. Foreign currency inflows dried up. Dollars left the country. Banks no longer had enough hard currency to pay depositors, and they shut their doors. Reuters later reported that the Lebanese pound collapsed from the long-standing 1,500 rate to around 23,000 to the dollar by late January 2022, after briefly hitting 34,000 that month. More than $100 billion became trapped in the banking system. Think about that. Not lost in a dramatic fireball, trapped, suspended between legal ownership and practical access. For ordinary people, the experience was devastating. Some depositors were locked out of dollar accounts. Others were told they could withdraw funds only in Lebanese pounds at fixed exchange rates far below the real market rate. In 2021, Reuters reported a common withdrawal rate of £3,900 per dollar from certain accounts, which meant savers were effectively taking a steep haircut, a polite financial term for getting back much less than the face value of what was yours, a polite word for a brutal reality. And the stories became surreal. Reuters reported that Arif Yassin, who headed Lebanon's engineers syndicate, fought over $20 million in funds meant for health care and pensions for about 100,000 people. Another depositor, Dana Trometer, said her mother could not get even a penny of trapped retirement savings for daily essentials. Lawyers filed hundreds of suits. Some people later stormed banks not to rob strangers, but to retrieve their own savings for medical bills. When a system reaches the point where citizens must threaten violence to access money they legally own, the crisis has moved beyond economics. It has become a public indictment of the state itself. Notice the mechanism. In Argentina, access was cut and contracts were rewritten. In Greece, liquidity vanished and withdrawals were rationed. In Lebanon, deposits stayed visible, while exchange rates and withdrawal rules hollowed them out from within. Different methods, same injury. The balance told one story. Daily life told another. Most people will never know what you now know. Most people will keep trusting systems they do not understand. If you are still here, you are not most people. Hit subscribe. Because the next section is the part this channel was made for. The part they never put in textbooks. Now look at all three together. Argentina in 2001, Greece in 2015, Lebanon after 2019. Different countries, different currencies, different political systems, same mechanism. Banks made promises of fast access to money that was ultimately tied to slower, riskier, less liquid assets. Governments leaned on banks to finance weak states, defend exchange rates, or preserve political calm. Depositors believed the system was stable because it had been stable yesterday. Then confidence broke, and the hidden architecture became visible. The same mechanism, different countries, different decades, same result. When fear rises, deposits are not just savings. They are runnable liabilities, which means obligations that can rush out the door at once. When banks cannot sell assets without taking heavy losses, or when those assets are claims on a government already in trouble, the bank becomes a mirror, reflecting the state's weakness back onto households. That is why banking crises so often arrive together with currency crises and debt crises. They are not separate storms. They are one weather system seen from three windows, and wealthy countries are not exempt. In the United States, Washington Mutual was closed on 25 September 2008 in the largest bank failure in American history. The FDIC says the bank had about $307 billion in assets and $188 billion in deposits when JP Morgan Chase acquired the banking operations. For depositors, the transition was startlingly smooth. ATMs kept working, checks kept clearing, direct deposits continued, but the same FDIC material makes clear that shareholders and certain debt holders were not protected. That is the crucial point. Two people can live through the same bank failure and tell completely different stories depending on where they stood in the legal order. There is one more detail worth sitting with. The FDIC says 140 U.S. banks failed in 2009 alone. Most people cannot name them. Why? Because a credible safety net can make a bank failure feel like a legal transfer instead of a social trauma. Branches reopen under new ownership. Debit cards keep working. The losses are pushed up the chain toward shareholders, unsecured creditors, or the deposit insurance fund rather than straight into kitchen tables. That does not make the problem small. It makes the architecture visible. The same banking crack can produce two very different human outcomes, depending on whether the state still has the strength and legitimacy to absorb the shock. And that contrast helps explain why Argentina, Greece, Cyprus, and Lebanon felt so frightening. In each case, the state itself was part of the weakness. The hand meant to steady the table was already trembling. Once that happens, every promise inside the banking system starts to look less like money and more like a negotiation. Then came Silicon Valley Bank in March 2023, a reminder that in the digital age a bank run can move at phone speed. The Federal Reserve's watchdog later reported that more than 94% of SVB's deposits were uninsured at the end of 2022. On 9th of March 2023, customers withdrew $42 billion in one day, nearly a quarter of the bank's total deposits. Pending withdrawal requests for the next day reached $100 billion. That is not an old-fashioned queue around a branch. That is a silent stampede through apps, treasury dashboards, and chat groups. The old movie of panic is people standing on sidewalks. The new movie is numbers disappearing before lunch. At this point, the pattern becomes impossible to ignore. Bank failures are not mainly stories about vaults being empty. They are stories about promises made against time, backed by assets whose value depends on calm. Once calm breaks, the legal and political system decides who gets cash, who gets delay, who gets equity, who gets conversion, and who gets wiped out. Your account balance is the label on the box. Crisis reveals what is actually inside it. And this is where history gets personal. Who gets hurt the most when banks start failing? Usually not the people with the fastest lawyers, the widest networks, or the easiest access to offshore accounts. Usually it is the middle layers of society, the people who did what they were told, savers. Pensioners, small business owners, salaried workers, people with enough money to keep in banks, but not enough power to shape the rescue. Take Cyprus again. Insured deposits under 100,000 euros were protected, but the island's banking system had grown far larger than the economy beneath it. Reuters reported that deposits above 100,000 euros at Bank of Cyprus were converted into a mix of shares and frozen claims, with large losses that could approach 60%, while Likey's uninsured depositors were hit even harder as the bank was wound down. That meant many small firms, family businesses, and professionals were suddenly financing the rescue through money they thought was liquid. The state did not need to seize every account. It only needed to reach far enough into the layer that carried payrolls, inventory, school fees, and working capital. In Greece, the blow fell hardest on those who lived close to the cash economy. A wealthy household with money abroad could wait. A pensioner with no card could not. A large company might find credit lines or foreign suppliers willing to extend terms. A neighborhood pharmacy, market stall, or family-owned guest house had to manage within the daily ration of the banking system. A crisis is often described in averages. Real suffering happens in intervals: the week before payroll, the day medicine runs out, the hour before the landlord knocks. In Lebanon, the cruelest divide was between nominal wealth and usable wealth. Some well-connected people were accused of moving money out early, while ordinary depositors stayed trapped. Reuters quoted depositors saying elite people were always transferring money out while normal people were not getting the same treatment. That sentence captures a pattern older than modern banking. The ladder is open at the top first. By the time the crowd at the bottom sees the smoke, the stairwell is already full. Argentina showed another layer of pain. When deposits were frozen and then converted under new rules, the middle class took a deep blow not just to income but to memory. Savings are stored time. They are years of skipped vacations, delayed purchases, extra shifts, and quiet discipline. When a banking crisis destroys savings, it does not merely reduce a balance. It erases compressed years of ordinary sacrifice. That is why these episodes feel so intimate. The state is not just touching numbers. It is reaching back into the past and rewriting what your caution was worth. Who walks away fine? History suggests a small set of people often fare better. Insured retail depositors in orderly resolutions, like many WAMU customers in 2008, may experience inconvenience rather than ruin if authorities move fast enough. People with diversified access to cash and payments often suffer less than those dependent on a single bank. Institutions with political access frequently exit before rules harden. And those who understand that a bank deposit is a legal claim rather than a pile of reserved cash are less shocked when the claim is sliced, delayed, or redefined. The tragedy is that this knowledge is rarely distributed evenly. It flows through elite circles first, then reaches everyone else when it is too late to matter. The question is not whether this pattern will repeat. History has already answered that. The only question is whether you will see it before it sees you. If this channel helps you think differently about the world you live in, subscribe. It costs nothing, and it might change everything. So, what did the survivors do differently? Not the lucky speculators, not the insiders with perfect timing, the ordinary people who came through these periods with less damage. The historical record shows that they largely shared three characteristics. First, they understood the difference between value and access. They knew a bank statement was not the same thing as immediate control. In crisis after crisis, from Argentina to Lebanon, the people who adapted fastest were the people who recognized early that money can remain numerically present while becoming practically distant. They did not confuse a screen with a guarantee. They treated the banking system like a bridge that could narrow without warning, not a road that stayed 4 lanes forever. Second, they avoided single-point dependence. Again, this is not financial advice. It is a historical pattern. People who relied on one bank, one payment channel, one currency arrangement, or one political promise were far more exposed than people whose lives had some redundancy built in. Redundancy sounds boring. It simply means having more than one way to reach the same destination. In engineering, redundancy keeps planes in the air. In monetary history, it often keeps households functional when one institution suddenly stops serving its basic purpose. Third, they moved before the crowd, not because they were geniuses, but because they paid attention to incentives. They noticed when banks were offering abnormally high returns. They noticed when governments were leaning on banks to absorb too much public debt. They noticed when insured limits were far below business balances. They noticed when officials kept saying the system was sound while also discussing emergency measures. In history, the winners are rarely the fastest runners once the fire alarm rings. They are the people who smelled smoke while others were still complimenting the wallpaper. There is a more subtle trait, too. Survivors were often emotionally flexible. They were willing to accept that a safe-looking world had changed. Many people lose the first battle in any banking crisis, not in the branch line, but in the mind. They cling to the old map after the river has changed course. They wait for normal to return because admitting the change feels humiliating. But history is full of people who survived precisely because they stopped arguing with reality faster than everyone around them. And current conditions still rhyme with these old stories. In the United States, the FDIC has noted that uninsured deposits across the banking system rose from $2.6 trillion in 2007 to almost $9 trillion in 2021, before easing to $8.2 trillion at the end of 2022. The number matters because uninsured money is more likely to run when confidence wobbles. The 2023 failure of Silicon Valley Bank showed how quickly concentrated depositors can move in a world of instant communication. That does not mean every large bank is doomed. It means the old mechanism still exists. The river is modern, the current is ancient, so return for a moment to that print shop owner in Nicosia. The shutters are still there, the invoices are still there, the daughter still needs tuition, But now the meaning of the bank account has changed. The number is no longer simple. Some money may be insured, some may be delayed, some may be converted, some may survive only because a stronger hand steps in fast enough. The comforting fiction was that money in the bank was the same as money in your hand. History says that is only true while the wider system remains trusted. That is the real lesson. When banks start failing, your money does not follow one path. It enters a hierarchy. If the rescue is swift and credible, you may barely notice more than a weekend of headlines. If the state is weak, the currency is fragile, or the losses are too large, your deposit can be frozen, rationed, inflated away, converted, or left stranded behind legal barriers. The balance may survive, the usefulness may not. This is historical and educational analysis. It is not financial advice. Every individual situation is different. Please consult a qualified professional before making any financial decision. This video is not for everyone. Most people will dismiss it. But if one person in your life needs to hear this, share it with them. Not because it will change the world, because it might change their world. Subscribe for more, and I will see you in the next one.